Welcome back to the show where the markets are doing well. So let's get in one expert now to tell us about the hits and misses this earnings season. Vinay Khattar, Associate Director and Head of Research at Edelweiss Financial Services joins us. Hi Vinay, good morning and thank you for being with us. You've identified some stocks that have done well this earnings season and KPIT Technologies is one of them. Just take us through what your prognosis is for that company.
So if you look at the KPIT business model, they are into providing IT services for the auto companies. Now, if you look at the entire IT outsourcing space, auto engineering has been one of the spaces where IT penetration has been relatively low as compared to, let's say, BFSI or telecom and other such sectors. Our sense is that this space is going to expand very, very rapidly going forward. IT penetration will go up. Currently, auto companies outsource only about 7% of their R&D pertaining to engine and engineering and so on. This could go up to almost 14% over the next 3 to 4 years, which provides KPIT a big opportunity. Plus KPIT, because of its earlier tie-up with Cummins, is in a very, very sweet spot in terms of its technology capability, and it should do pretty well. Now coming specifically to this quarter, this particular segment, this particular SBU has done very well. It's grown at almost 24% top line growth, eventually leading to a blended growth of about 8.5% at the overall company level. This traction can continue. Another place where KPIT has done well is in terms of their SAP business. The SAP business was underperforming for last 2 or 3 quarters because most of the companies had moved to the cloud computing, where KPIT was still in the process of catching up. That has happened, and this quarter they have begun to show some kind of a turnaround happening there. All said, it's still available pretty cheap, 9.5 times FY16, an attractive bet, maintaining its growth momentum, and this should see a lot of traction in terms of market capitalization going forward.
All right, point taken. But what doesn't appear cheap at this point in time is your next hit, which is Symphony Limited. It's risen by 322% year to date. Still not an expensive stock. Why do you still like it?
Symphony has always been expensive, Lata. When we started covering, we covered it at 350 rupees just about 2 to 3 years ago. It's at 1400 rupees, and it's still a very, very interesting bet. And I'll tell you why it's so interesting for us. Symphony is into cooler business. Now, most of the business, or a large chunk of this business is in the unorganized sector. Symphony, in terms of value terms, is 50% of the market share in the organized sector.
Okay.
Every year it launches 1 or 2 products. It's got domestic presence, which is significant, a large distribution setup. And something which is very peculiar to this business is that they allow only cash and carry, which means my working capital cycle is very, very tight. Most of my manufacturing is outsourced. So net, I have a return on capital which is almost 40% plus. There are not too many businesses who can talk of these metrics.
Okay.
In addition to this, company has shown a consistent growth of about 35 to 40% in last 5 years. That's the annual CAGR they have been clocking.
Okay.
In addition, you have an export business in which Symphony wanted to be present in countries where there is a tendency to have very dry air. So in places in US like Texas and all, the moisture content is very, very low. So people prefer air coolers there in contrast to air conditioning. So those are the markets in which Symphony would want to be present. They have done an acquisition in Mexico, and then the international business continues to grow healthily.
Okay.
So net at these kind of ratios, the multiples look justified, and if it maintains growth momentum, the stock could still do well from these levels.
No, you said that it's a 35 to 40% CAGR earnings growth, but what is the earning? What is the valuation at the moment? Say,
at the moment the valuation would be cheap. It will be about 20 times plus 1 year forward, which is FY16. They're likely to report a PAT of about 170 to 180 crores with a market cap of 5,000 crore plus. That makes it slightly on the expensive side. But the bet is that very good quality stocks are never going to be cheap. So whenever you have strong market corrections due to macro reasons, these could be very interesting buys to be put in your portfolios.
In fact, what a phenomenal move it's had this year, about 324%, so great run for Symphony. You've picked out a couple of misses for us. I just wanted to go through Keval Kiran. The numbers don't look so bad. I mean, the revenues are up about 11%, the profits are up about 3% or so. What did you not like about the earnings this time?
So if you look at Keval Kiran, it's a significant brand owner in the domestic jean space where the Killer brand exists. In addition, they have other brands called Lawman and Integrity. Now, what's gone wrong with Keval Kiran in this particular quarter, and we've seen some trends of that happening in the last quarter, is that their gross margins are dropping. At the gross margin level as well as at the EBITDA level, we've seen a contraction of 3%. Now, their realization has improved by 4% plus, volume growth has improved by 4% plus. So this tells us that despite having significant traction both in terms of volume as well as in terms of realization terms, my costs are going up appreciably. And this also indicates that the cost increase is so high that I'm not able to pass through, have a complete pass through of the price. And that is what is causing a bit of concern to us at this stage, that if the cost pass through is not happening, could margin pressure continue in the coming quarters? At which point one then ends up taking a look at the other ratios and the other numbers, and at 20 times plus, the stock may not be really cheap if the margins come under pressure over next 2 or 3 quarters.
Okay, and what didn't you like about Biocon, Vinay?
Biocon is a short-term pressure, that's what it appears. They have had pressure in the MENA region, that is the Middle East. There has been a lot of political unrest, because of which company has had a lot of credit problems. In the last quarter conference call also, the company indicated that we would want to go slow in that region and probably withdraw, and not because the demand is low, but because we are having serious credit issues in those particular geographies. So that is one factor which is impacting the company in that particular geography. In addition, there have been 1 or 2 drugs for which the API pipeline had slowed down. The company had indicated that again in the last quarter, and most likely that is likely to pick up from Q3 onwards. So these 2 factors have had some kind of impact on Biocon numbers in the short term, and that's what is probably holding up the stock. A few of the key triggers on the longer term for Biocon could be very, very interesting, which includes Syngene listing and the Malaysian facility coming up over the next year, which could cause a higher degree of traction on the price.
But you may get it cheaper, is what you're saying?
Yes.
All right, that's useful advice. Thank you very much, Vinay Khattar, for joining us with those hits and misses of this earnings season. And those are some gems for you from Vinay Khattar, the Associate Director and Head of Research at Edelweiss. We'll take a break on that note.